Hey, this is Scott Rulon. So happy to be with you today. I just wanted to review some of the 2021 tax changes. I know we're coming close to the end of the year, and that dreaded meeting with the IRS is about to show up, at least from that January to April period in which we all have to file our tax returns. So I just wanted to make sure while we had a couple weeks left in the year, I could review some of the changes that took place so that you could make changes accordingly before the end of the year. So again, this is Scott Rulon. Please don't forget to like, comment, share, and subscribe. And don't forget to hit the bell icon so you can receive future videos like this. So let's go on with some of the tax changes. So certainly there are a lot of tax changes for 2021. There was a revamped child tax credit. If you had a child under the age of 6, since July you should be receiving $300 a month, which would amount to about $1,800, and then you'll be getting another credit on your return this year for an additional $1,800. So you would get about $3,600 in credit. If your child is between age 6 and 17, you started getting $250 a month per child in July, and that should round out to about $1,500, and you will receive another $1,500 once you file your tax return. The great thing about those is, guess what? They are tax-free. They are just a advanced credit for having kids. So they were really designed to help pay for child care, other such things, with as long as you have a couple working parents. So that is a wonderful thing, and so I'm sure many of you have received that money as a godsend, and it's sitting in your account as we speak. Also this year, millions of taxpayers certainly got a third round of stimulus checks, $1,400 for singles and $2,800 for joint filers, plus an additional $1,400 for each dependent. And again, this is an advanced tax credit, so you're not going to have to pay taxes on it because it is an early advance of money that you'll be receiving on your tax return. That's exciting. And another thing in the area of kids, so if we have two working parents and the kids go to daycare, guess what's happened? They have raised the amounts that are eligible for the dependent care credit. $4,000 for one child and $8,000 for two or more kids. So that's up from $1,050 to $2,100. And so that's a great thing for working parents. You ought to be excited about that. Also, working parents can contribute more to a dependent daycare FSA. It stands for Flexible Spending Account. So you can put actually up to $10,500 of your pre-tax wages into that account. So that is a great thing. So I want to give you an example of how that helps you tax-wise. So just to use some round numbers, let's pretend you got paid $10,000 a year and you put $1,000 into that dependent care. And so that would leave you with $9,000. So instead of getting taxed on the $10,000, you'd only get taxed on $9,000. So that's a wonderful thing for all of you parents. The other thing is, since most of us cannot itemize anymore, the government has thrown in something extra, which means if you decide to contribute to charity and you are a non-itemizer, you can still take up to $300 of charitable tax contributions if you are single, or you can deduct $600 if you're married filing joint corp. So that's a great thing. One of the things that they did happen to take away, for those of us that do have kids in college, we had a couple choices about whether we wanted to take a tuition college deduction or we wanted to take the American Opportunity Credit. After 2020, the tuition deduction was taken away, but we can still use the American Opportunity Credit, which, by the way, is a refundable credit. That means that if this credit is more than your taxes, you can get extra refund because of the credit. Among some other tax changes that we've seen, if you're still able to itemize, they made permanent that if you have medical expenses over 7.5% of your adjusted gross income threshold, you can deduct those. And the other interesting thing is for those of you who are paying off college debt, you can exclude from a worker's wages the first $5,250 of college debt paid by your employer. So that becomes absolutely tax-free. Other things that were extended through 2021, for those of you that got mortgage loans, and let me tell you, there was hundreds of thousands of you, you can still deduct your mortgage insurance premiums. So those usually come about because we can't put down more than 20% on our loan, and so the mortgage company requests some mortgage insurance. So good news is we can still deduct those premiums. We still can deduct small credits for business and energy tax incentives, so that's putting like energy efficient windows and doors to one's residence. There are more employer-related payroll tax credits for employers. So if you're a small business employer and you took some of those payroll tax credits, good news is that's been extended. Great news, something that had been taken away under the Trump administration, businesses can deduct 100% of their business meals in both 2021 and 2022. So even prior to this time, you could deduct 50% of your business meals, but for 2021 and 2022, you can deduct 100%. But let's not forget that entertainment is no longer deductible and it was completely taken away. So let's not worry about that. What other things can we do? So, let's say you lost money on a business. So what you could do is you can take credit for the business losses over $500,000 for a couple and $250,000 for other filers. Prior to this time, that was made non-deductible, and any excess beyond that would have to be carried forward into the future. So originally this was slated to expire in 2025. Well, now it's set to end after 2026. So that's a wonderful thing. The other thing for businesses, the $1 million deduction cap for executive pay is broadened. So that's a good thing. So you can keep deducting that. And the other thing is the income tax brackets were made a little bit wider. So what that really means is if I made more money, they expanded the bracket in which I have to pay a certain percentage of my income. So as we sit today, the brackets sit at 12%, 22%, 24%, 32%, 35%, and the highest bracket, of course, being 37% in 2021 a bit. So married couples get $25,100 as a standard deduction, plus an extra $1,350 for each spouse age 65 or older. Singles can claim $12,550 for their standard deduction, or if they're over 65, $14,250. Head of households get an extra $18,800 plus $1,700 extra once they reach 65. Blind people receive $1,350 or more and $1,700 if unmarried and they don't have a surviving spouse. There is, in addition, some reduced taxes on capital gains. This is if you sell a piece of stock or you sell some rental property. And so those of you that have ever looked at your mutual fund statement, you'll see that there's a thing called qualified dividends. So if those dividends are qualified, they're subject to basically a lower tax rate. So you don't pay any taxes on that, or a 0% rate if your taxable income as a single person is $40,400, or if you are a head of household, you don't pay any tax on those gains if they're $54,100, or for a joint tax return, you don't pay any tax on those capital gains if your income is $80,800 or less. Once you reach $4,445.851 for singles, your capital gains rate is 20%. $473,751 for head of households, and $501,601 for couples filing jointly. The 15% tax rate is for filers with taxable incomes between the 0 and 20% breakpoints. Just remember there's a 3.8% surtax on investment income, which kicks in for single people with AGIs over $200,000 or $250,000 for marrieds. Although this may not apply to some of you, the lifetime estate tax and gift tax exemption for 2021 jumps to $11,700,000 or $23,400,000 for couples if they elect portability. And so you get that by filing on a Form 706. Probably many of you will never have to deal with that, but it's nice to know about. The gift tax exclusion actually happens to do with giving money away. So you can give up to $15,000 per donee tax-free, or really $30,000 per couple if your spouse agrees, so you can give that money to your child, grandkids, or any other person, and they would receive that money absolutely tax-free, and so would you. On the business front, 2021 had a standard mileage rate of 56 cents a mile. The mileage rate for medical travel and military move dropped to 16 cents a mile. And the charitable driving rate stays at a cool 14 cents a mile. For those of you that are in business, there's the famous 179 deduction. That means that if you buy a fixed asset, this tells you how much of it you can expense immediately. So this year in 2021, you can expense $1,050,000. And this amount phases out dollar for dollar once more than 2.6 million assets are put into service. So that's kind of interesting. The annual cap on deductible contributions to HSA rises. So remember, HSAs can be deducted in the adjustment lines the same place as IRAs. So you can deduct $3,600 for a self-only coverage HSA, and $7,200 for family coverage. And people born before 1967 can put in $1,000 more. So that's a nice thing, good deduction for us. So other things, for those of us that are over 50, we're concerned with things like long-term care. So they certainly raise the amount of premiums that are deductible. So for filers between age 61 to 70, you can deduct $4,520 of your long-term care. If you're 51 to 60, you can deduct up to $16,090. And for individuals who are 41 to 50, they can take in $850. And people 40 and younger, if you have long-term care, you can take $450. And so also on the education front, 2021 income tax or income caps are higher for tax-free municipal bonds. So basically what we're saying is if you use municipal bonds to save for college, if you use that money to pay college tuition for your kids or grandkids, that can come out tax-free. So you don't have to pay any tax on that. And so those are some of the interesting changes for 2021. So if you can take any advantage of those in the next couple weeks before we hit 12/31, you should certainly do that. So again, my name is Scott Rulon. I am a practicing CPA in the state of Arizona. And so I've been doing taxes for decades now. So if you liked what I had to say today and you want to tune in for my 2022 tax planning broadcast, please like, comment, share, or subscribe to my channel. And don't forget to hit the bell icon because you will receive future videos that way. Thank you so much for taking the time to listen. I look forward to speaking with you in the future.